Benefits of adding profit targets. So this is kind of a play on the option drive that we did. We're going to be looking, and we did that this morning as well. But we're going to be looking at like 50% or 21 days. That's kind of the second part here of this this little series for the day. So benefits of adding profit targets. Let's do it.
I'm ready.
So managing short premium positions prior to expiration comes with a variety of risk mitigation benefits, and some early management strategies include at specific points in the duration. So we talk a lot about 21 days when you're starting at that 45-day time cycle. At a specific profit target, so 50% is kind of our wheelhouse. We looked at 10 and 30% as well. Once you get closer to that 50%, that's kind of the optimal spot. And then at a specific loss threshold, so a lot of times we talk about 2 times the initial credit. That's mostly for undefined risk trades or some combination of all of these. I think this is really the important part here is that you have to have a little bit of flexibility here. There's no perfect exact, you just because you roll at 22 days versus 21 days, there's not a huge difference there. I mean, like you got to kind of be managing your positions as they go. Did you just move? After all this talk, I want to tell everybody what just happened. I put my spread in at 175.
I'm watching the market. I'm watching the market as you're trading.
Now that he kind of wants to be in this position, this little Johnny comes in and moves it to 173. You moved it 2 cents. Like if you really wanted that position,
put yourself in a ballpark.
Put it at 170.
It was 180 and change when I was looking at it.
How many times you worry about the 1 penny? I know
a lot. You'd be surprised with what you used to spend when you were a kid. Forget about it.
Oh my God!
I had to make every penny I could get. You were saying benefits of adding a.
Oh no! Now it's at 167. If you would have went in at 170,
oh man, I'm fine. I'm watching the market. Nasdaq's still weak. I'm good.
Ugh.
Volatility up a nickel.
Kiss of death. You just got the
KOD.
You just KOD'd it. They moved 10 handles and you said that. Next slide, please. Short options tend to be especially volatile toward the second half of the trade. So managing at a specific point in the duration, typically around that halfway mark, is considered one of the most important things that we do. I mean, like we always talk about removing some of that P&L volatility. The easiest, most mechanical way to do that is just to roll around that 20 to 30 day time frame. I mean, that's just halfway through the duration of the trade. What if any, are the benefits of adding profit targets? We're going to take a look at the same SPY strangle and kind of look at profit targets as well as managing the trade here for this one. So next slide here. So the study is going to be the 45-day strangle, 16 delta on SPY. So we're looking at the 2016 to present time frame. We're going to compare the following management strategies. So 50% of the initial credit only. So we are sitting at 50%. 21 days only. So we're managing at these 2 very specific spots, or 50% of the initial credit or the 2. So we're looking at each individually and together.
Getting a little granular here.
Yes, and very specific. I mean, these are exact spots here. So we're going to be looking at pop, median P&L, standard deviation of P&L, and of course your covariance of risk, which is your 2 standard deviation risk here.
Very good. Let's see what happens here.
Next slide here. So comparing managing at 21 days, managing at 50% results only. So looking at those specifically, the managing at 50% profit target resulted in a higher median P&L and a higher pop because the position has more time to be to potentially reach the profit target and become profitable. So you can see, managing the trade at both 50% and 21 days are going to be high pop decisions. When you get into that 50% or 21 days, that's really when you kind of limit a lot of the CVAR there. That's where your lowest CVAR comes into play. So you can see here, these are both good management techniques. They're both mechanical.
Both mechanical, yes. And I mean, just like the last one that we looked at in the option jive, it looked like the 50% of initial credit, but you know what? You're staying in that trade a lot longer.
Yeah.
It's harder to do in practical application than it is to do a study on it. So. Yeah. I mean, it's good and better here. It's optimal and better. All of these work.
You will see that the deviation of your P&L is going to be a lot wider when you are waiting specifically for 50%, because a lot of those trades that aren't right at 50%, you're going to then be holding those past 21 days. And so you have a lot of that gamma risk in those positions. So, that's kind of the big point here is that these two go hand in hand. If you're not at 50% at around halfway through the duration, you should be rolling the trade.
That's
for
correct.
Short premium naked positions like this.
Yep.
Next slide here. So because the profit target may never be hit, it also results in nearly double the volatility, which is our standard deviation of P&L, and tail loss potential on those 50% specific trades. So if you're not getting to 50%, what this is telling you is that it probably doesn't get to 50% at any point. Like this trade is probably just a losing trade, which means you should have managed it to begin with. Like that's why we are managing trades, is because they're losing trades. We're not managing
there's variables
winning
here that you can't put in the study really.
that you're not seeing in each occurrence here. But that's really the key here, is that the CVAR is a lot wider if you're looking for that 50% and not including the management at a duration point.
CRCL, you got filled 260.
That's my price.
Yeah. Thanks, Dad. Go ahead.
He's the best. He's a former market maker, I think.
That's right. That's right. Nobody can wait him out like me.
Now he's a retail market maker because we made that market.
That's right. It's an opening trading circle. Good job out of you.
Very nice. Next slide here.
Which means the stock is going against you if you're getting filled at your price.
Yes.
Let's put that in perspective.
Bullish position.
There was no gift given there.
It was no gift.
That's
it was
right.
no gift. Yeah. It means I really, my real fill was at 61 cents.
That's right. That's right.
I gave up the penny, but
Probably.
it was based on where we were before. So, however, when 21 days is added to the 50% target, when you supplement it there with the profit target of 50%, the profit target is hit prior to 21 days, roughly half of the time. So this kind of goes to the reason why your CVAR is wider when you're looking at just 50% management, is because only half the trades are getting closed at that point. So the other half, you have a much wider deviation because you're holding those basically up until expiration because you're not hitting the 50%. When you incorporate the 50% and the 21-day management, which means you're taking off the winners and then rolling the losers, you can see you flatten out and you really tighten up your deviation of returns here. You have a median P&L per trade of $100, which is a little bit higher than the 21-day manage, but a little bit lower than the 50%. But your standard deviation of risk, which is your standard deviation of P&L, is going to be lesser than both those two. So you have tighter, more, your expectation for profit and loss on the position gets a lot more similar. Missed out on a word there. I'll think of it. Tighter, less volatility.
Fine.
Next slide here. So
I was hinging on that word. You really, you didn't. And it's sponsored by the CBOE, so I figured you would come up with something really good here, but you didn't. But you didn't disappoint. That's okay.
Reliable.
There you go. Reliable.
That's a good one.
That's a good one.
Your expectations become more reliable.
That's good. That's good.
Overall, this results in a higher median P&L, less per trade volatility, a higher pop, and less extreme tail risk losses. This is when you are incorporating both 50% management and 21-day. One of the two, those are your management techniques. That's your very basic mechanics that you should be incorporating into all your strangles across the board. A couple takeaways here, and then we'll get to the board.
We'll move on.
Managing short premium positions by a profit target alone does not offer as much protection as managing by duration because the target for profit may not always be reached. If you think about this, even if you extend the profit target, so if you're looking for 70%, let's say, it's going to be even wider. So like as you get more, as your expectation for profit gets higher, or your your expectation for profit gets higher, your deviation is going to be much, much wider on your P&L. However, when you add in the 21-day management, it supplements with and you supplement that with a 50% close, the positions are managed even sooner than 21 days, roughly half the time.
That's a good thing.
That's a good thing.
It's a great thing.
Because you tighten,
that's
get more reliable.
That's right. And you get to use that money someplace else too, which we never talk about in these studies. So, you get filled a week or 2 weeks later, you're still in the time frame to add more trades on something else that has higher implied volatility. So the results could be even more powerful. Powerful is a good word.
Powerful with higher median P&Ls, higher pops, less trade volatility, P&L volatility, and lower tail losses than compared to managing by duration alone. So it's important to incorporate both these things into your trading.